Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with our colleague, Stansberry Research senior analyst, Alan Gula.
Alan is our colleague and friend, great guy, very, very smart. We're lucky to have him with us. So rather than waste any more time talking about him, let's talk to him. So let's do it. Let's talk with Alan Gula. Let's do it right now. Alan, welcome back to the show. Pleasure to see you as always.
Yeah, thanks for having me.
So for our listeners' sake, overwhelmingly, we invite guests on the show and we say 5, 4, 3, 2, 1, go, and we just talk. And every now and then, on a rare occasion, we exchange an email or two, and they want us to prepare, like that's a thing. And so Alan and I, we and Corey and I exchanged some emails, and Alan definitely has something on his mind here. And we specialize on this show in letting people talk and tell us their ideas and make them crystal clear. It's less about what Corey and I think and more about what our guest thinks. So, Alan, that said, you do have some very specific things on your mind, and you provided us with charts, which is another thing that hardly ever happens. And you're concerned about the long-term trend, or you're interested in talking about the long-term trend of the S&P 500 and the boom in capital spending among big tech companies, the secular bull market. So I'm curious to hear what you have to say about all this. So let us have it, man. Give it to me. What do you got?
I always think it's helpful to back up and take a long-term perspective. And I'll just run through these charts pretty quick. The first chart is of the S&P 500 since 1957. That's when the index expanded to 500 companies. The upper pane has a log scale, or else this would look like a giant curve. And that red line is the long-term trend with the benefit of hindsight. It's basically a 7.5% compound annual growth rate. And the lower pane shows the deviation from trend. And in the late 1970s, early 1980s, you could see the index was running about 50% below the current trend. And it got down to 50% below trend again during the global financial crisis briefly. And something else that really stands out on this chart is the tech bubble that peaked in 2000. The index was 100% above trend. And so today, the S&P 500 is about 35% above trend. So we're running hot, but it's not at an historic extreme. So that's the long-term perspective. If we could maybe zoom in on the last 15 years, this is also a chart of the S&P 500 on a log scale. This is a different trend line. This is just the trend line since 2010. And we've been in what a lot of technicians call a secular bull market since 2009. And there have been two cyclical bear markets, the COVID crash in 2020 and in 2022 from the inflation shock. And of course, the official definition of a bear market is a 20% or more drawdown on a closing basis. And then we've had three near bear markets, one in 2011 during the European sovereign debt crisis, another in late 2018. And then we just had yet another near bear market, another 19% decline. And in my opinion, these 19% declines they're effectively bear markets. It's for all intents and purposes. We even got there on an intraday basis. And so we'll return to this, but if you had a truly diversified portfolio, this latest 19% drawdown wasn't really all that painful. And so now the big question is whether the secular bull market continues. Could the AI boom help carry us even further above trend? It's certainly possible. Could it even cause a 1999 style bubble? Sure. And so given the parallels between the internet, the rise of the internet and generative AI, both touted as these revolutionary technologies and with undeniably rapid adoption, it might even be strange to see if we didn't see another further melt up. And then on the other hand, um, could the secular bull market be on its last legs? Of course. Could the market go sideways and be choppy for 10 years? Sure. And I actually think that that would probably cause the most pain for the most amount of people. And so I think this is why um, investors should have a balanced approach, a bit of yin and yang in their portfolios. You want your so-called get rich securities, but you want your stay rich securities to help manage the downturns. And then last chart. So if the market, we're now sitting almost at all-time highs in the S&P 500. Again, the market has ripped higher since the April lows. And so I think people are just realizing that and the earnings announcements reinforce it, that the underpinnings of the AI boom and the AI trade are intact. And one big driver of that is tech capex spending. So Microsoft, Alphabet, Amazon, AWS, Meta Platforms, Oracle, and I've even thrown in CoreWeave, the up and coming AI hyperscaler that's going to do about $20 billion of capex this year. So these large tech companies, they're likely to spend nearly $350 billion combined on capex this year. That's up 40% from 2024, which was up 70% from 2023. And so it's just a gargantuan amount of spending. A lot of this is going into data center construction and buying chips, and it just doesn't seem to be an end to this, at least not yet. So it's unclear whether this capex will have a good return on investment. But I'd rather ride the waves than fight the tide on this trend.
Sure, and overall, lots of investment in a new, potentially wonderful technology is a good thing, right? I mean, this is how capitalism works. Everybody gets excited; they want to invest in something. I mean, it goes without saying that not all the investment will produce a great return, but I bet some of it produces a fantastic one, right? I mean,
Yep.
so sounds like you're cautious, you're aware of the trend, but and so then you have your stay rich securities, and I've said this a bunch of times, don't run out and sell all your stocks. Hold those great businesses, and it sounds like you're in the same place overall.
Yeah, exactly. And so basically, and I alluded to it earlier, if you have a fully diversified portfolio, you basically weren't all that worried during the April downdraft. And that's because people are saying, well, the 60-40 is dead, and the 60-40 is the 60% stock benchmark, 40% bonds. And what they're really saying is, oh, well, we hate bonds. But I'm not sure if the 60-40 is dead, but I just think that traditional asset allocation, traditional diversification, having 40% of your stay rich sleeve in bonds, that's over. So we have, with the total portfolio, our goal is to build wealth over the long term with a balanced, universally diversified portfolio that's less volatile than the S&P 500. So I contribute to our flagship newsletter, Stansberry's Investment Advisory, and then I'm also on the investment committee for the total portfolio, which I'm sure we'll get into.
Yeah. So no, let's get into it. The total portfolio is it's for subscribers, right? So we're not going to give away all the names, but maybe you can just characterize for us, like, what's in the get rich and what's in the stay rich. Like, what are some stay rich ideas that might wind up in there?
Yeah. Well, first, let me. I think there are a number of things that make this product special, and so one of them is security selection, and so maybe we could talk about that first.
Sure.
We have a lot of various publications at Stansberry Research, and that can sometimes create confusion as to for what our subscribers should buy and how large the positions they should hold. And the total portfolio is really the solution to that. We have an investment committee made up of myself, Director of Research Matt Weinshank, Brett Eversole, Whitney Tilson, and David Eifreg. And we review all of the recommendations across our firm and pick the most compelling, best risk reward recommendations. And so to give the audience an example, and Dan, I want to give you some props here. So back in 2020, you recommended Comfort Systems in Extreme Value. Do you remember that?
Sure do.
Right. So yeah. So for our viewers who may not be familiar with the company, Comfort Systems is a construction contractor that specializes in heating, ventilation, air conditioning, so HVAC, and then electrical and plumbing as well. And these are not the guys that come to fix your, the AC in your house. This company works on large commercial projects, and it's sort of one of the lesser known beneficiaries of the U.S. construction boom. It helps build lower tech facilities like hospitals and warehouses, but it's also in the last few years it's done a lot more data centers and even semiconductor fabs. And so its business is booming. It even has a $7 billion backlog. And Dan, you recommended the stock in November 2020. It went into the total portfolio in early 2021, and we've held it ever since. We've trimmed the position, and we're up something like 700% on it, and it's the second biggest winner in our portfolio behind Bitcoin. And so that's a great example of, when our process knocks it out of the park. You did a great write up on that, and I think Austin Root, who was our director of research back then, he put it in the portfolio, and so that's a great example of how, on the security selection, how that works. So
yeah, wow, Bitcoin and Comfort Systems, Dan. That's pretty. There you go.
That's right. If you just own those two,
Who would
you'd
have
be
thought?
great.
Who would have thought? But that's the point, right? That's when you have all these, like we do. I mean, we hear from subscribers all the time about what, all the different publications, and we send a lot of recommendations, and
Oh yeah.
this what Alan's talking about is really the solution to putting all of that together on risk reward basis and through everything. So if you haven't checked it out, you should check it out. But
Yeah, I was really happy when they started doing these. There are other portfolios as well, because it's true. We overwhelmingly, like across Stansberry, we all like to recommend like better businesses, generally speaking. So you've got all these publications that are trying to find the best business in some particular industry or another, or just generally. And you get, a few dozen or several dozen picks every year. Let's say if you're an Alliance member, and what the heck do you do with them? And these portfolio products tell you the answer to that. How do I navigate all of these recommendations? And obviously, Alan and the committee have done a really great job. People say you can't invest by committee. Well, maybe you can. And aside from the inclusion of Comfort Systems, I just feel an affinity towards this one, just because I think, you used the word fully diversified, Alan. I've honed in on the term truly diversified, but it all means the same thing. Whether you're really diversified, because if you just hold a bunch of tech companies or something, maybe you're not really diversified. So what makes in the total portfolio? I'm really curious to get to what makes you fully or truly diversified.
So broadly, we have individual stocks, we have ETFs, we have our U.S. exposure, U.S. equity exposure, we have foreign equity exposure, we have some fixed income, we have Bitcoin, and then you can get into some of the other things. It's basically it's modern asset allocation, it's modern diversification, and so we basically, how we think of it is, like I said, we put these picks into two buckets. There's the get rich and there's the stay rich. And the get rich section, that contains the positions that are really going to benefit from that continued secular bull market. These have higher risk, higher reward. In there, we have our capital efficient stocks. We have our compounders, small and mid caps. This is where we have our AI beneficiaries like Comfort Systems. Get rich is where our international emerging market exposure is. And then again, we have Bitcoin, and then we have our stay rich. And this is the more defensive securities. These will help you preserve your wealth while still providing a solid rate of return, solid real rate of return above inflation. And we do have some fixed income through some bond ETFs, but we also have property and casualty insurers, consumer staple stocks. This is where we have our gold exposure. There's typically some cash, and stay rich is also where we have our managed futures ETFs. We can get into that a little bit. So I think these are sort of the ultimate portfolio diversifiers. So that's how we sort of think about it. Now they're all together, but that's just how we categorize them. And then we also we consider, it's not just a list of stocks or a list of positions that we find compelling. It's also how they're going to interact. What are their correlations? How are they going to perform under different scenarios? There's different circumstances: high inflation, low inflation, rising yields, falling yields, and yeah. So that's how we're able to really provide universal diversification.
Yeah. So you're prepared for whatever the market might throw at you. Sounds like.
Yeah. And so because of that balanced approach, so our benchmark is not the S&P 500. It's the 60/40 benchmark, and specifically it's the Vanguard Balanced Fund, which is essentially a 60/40 fund. Since the total portfolio, the inception in 2017, we've produced a 157% total return. That's about 12% annualized. And meanwhile, the Vanguard Balanced Fund, that's returned about 100%. So that's a 8.6% annualized. So we've outperformed the benchmark, and we've had much lower risk than just a portfolio full of stocks.
When you say much lower risk, are you simply characterizing the risk that you see in the security some kind of way? Or are you measuring it by lower drawdowns or something like that?
Well, to give you an example, the S&P 500 was down 19% in April. The total portfolio was down 9%. So less than half of the drawdown of the S&P 500. And right now, year to date, I think the S&P 500 is up 4%. We're up 8%. So we're outperforming, and more importantly, we're outperforming with the benchmark too, but we're outperforming with much lower volatility than both the benchmark and the S&P 500.
It's dreamy, man. It's dreamy. It's like, give me some more of that.
Well, that's one of the problems with diversification. So a lot of times you're going to have these periods where you just hold stuff that is so out of favor. I know international stocks now are starting to catch fire this year, but we haven't had. We recently increased our international exposure last year, but those have just been dead weight. So that's really, so you sort of have to live through the periods of underperformance in some of these individual categories.
Of course, I was fooling around with you. I know, everybody likes to talk about a really great recent long-term performance or short-term performance, but it's the long-term that counts. But your long-term is really good, so there's that too.
Right.
So managed futures. Let's talk about that a little bit. I have that in the Farish report. Why include that? What's so good about that?
Yeah, so I think the general gist of, say, like asset class level diversification is you want to put a bunch of assets in there that have low correlations. So when something zigs, something else zags, and gold is a good portfolio diversifier on that measure as a relatively low correlation with stocks and bonds. But the managed futures strategy is even better. So, and you had Andrew Beer of Dynamic Beta Investments on your podcast in 2021, and Andrew is really a pioneer in this area of giving access to alternatives to retail investors. And so there are there are hedge funds and commodity trading advisors, or CTAs, that employ trend following strategies, basically systematic, model driven price trend following strategies. And what Andrew does is he statistically analyzes the performance of the managed futures index, hedge fund index, and he infers how the funds are positioned in aggregate. And then he replicates those positions by being long or short futures contracts, and puts that in an ETF wrapper. And it has a reasonable expense ratio, and it's really a great way to replicate this hedge fund strategy in your brokerage account. And so we hold one of Andrew's ETFs in the total portfolio, and another one from another ETF provider. But those are great. When you look at the long-term performance of the index, of the managed futures index, its correlation with the S&P 500 is actually slightly negative. And that's sort of the holy grail. It's very rare to be able to find something that has a negative, that have negative correlations over a long period of time. Because even what we've seen, and especially with bonds recently, even bonds can have a positive correlation with stocks, and that's caused some problems recently. But yeah, this managed future strategy has a low correlation with all the other stuff in the portfolio. It's the ultimate portfolio diversifier, and so we have a relatively big allocation to these two funds. And that's something I think that, again, this is what makes the total portfolio special. How many financial advisors are going to have exposure to alternatives like trend following, exposure to Bitcoin, individual stocks, ETFs. So this is another thing that makes the total portfolio special.
That's a great point. Almost nobody is going to do this for you. Nobody's going to put that list of assets together that you just named. And it's, for reasons that maybe we could agree are kind of silly. They have mandates and restrictions and limits and things. And there are rules about, what can go in this or that fund, and hedge funds have their charters and things. But in the end, none of that matters. None of those mandates and charters and restrictions matter. It doesn't, a lot of large institutions won't buy a stock under $10 a share. It's like, what is it? It doesn't mean anything, or under a certain market cap. Warren Buffett doesn't buy stocks under a certain market cap because it doesn't move the needle. So that's legit. But otherwise, you basically have to come to somebody like Stansberry, in order, who's independent of all of that, to get you and the other guys on the committee putting together a truly diversified portfolio like this, right? I mean, it makes me wonder, like, where are the other places? Like, off the top of my head, I don't know a money manager that does it.
No, I think I think some people are coming around to it. Recently, it's more of a push into private credit and stuff like that. Yeah. But the trend following, and also you've had Meb Faber on. He's a big trend following proponent. I also saw, which kind of shocked me yesterday. So Rick Edelman runs he founded a $300 billion registered investment advisor firm, and he just put out this white paper saying you should have anywhere from 10 to 40% of your portfolio in Bitcoin or in crypto.
40. Whoa.
And 10 to 40, depending on your age and risk tolerance. Yeah. And he's I think financial advisors are coming around. That was kind of shocking. It was really provocative, but he's saying that basically the 60-40 is dead because people are going to live a lot longer going forward. The lower growth in the 60-40 is not going to get you there. You're going to run out of money before you die, and you need to be looking at more high growth areas. Crypto is one of them. I don't know. I think that again, that allocation is kind of shocking, but it sort of validates what we've done. We've held Bitcoin since 2020 in the total portfolio. It's a relatively small position, but yeah, it's I think a lot more financial advisors are going to come around to crypto.
Yeah, so just an example of what I'm talking about is the old permanent portfolio, which has morphed over the years. So now it's like gold, silver, Swiss franc assets, real estate and natural resource stocks, aggressive growth stocks, dollar assets. And they've been doing this. I think Terry Coxon and Harry Brown founded that thing in like 1980 something, early 80s, 1982. So, they've been doing it a long time, no crypto. And for what it's worth. So I don't know, maybe I'm trying too hard to sell the folks on the total portfolio, but I really am that kind of enamored of it. And it really is like my style of investing personally.
Yeah. And Alan, to these points, I mean, you mentioned before that the bond portion of the 60-40 portfolio you think's dead. So why maybe explain a little bit about why you think that is the case, because I think that's maybe people are looking, and what alternatives may there be to that. I think that's part of the reason, a lot of people are thinking about Bitcoin more and more too, rightly or wrongly. But just why do you think the bond portion or bonds aren't what they used to be?
Well, since 2022, bonds have disappointed. The treasuries have disappointed as a portfolio diversifier. Look what's happening to gold the past few years, right? So people are coming around to gold. You don't just want to have bonds. You want to have a good you want to have an allocation to gold as well that sort of offsets some of that risk of inflation and inflation shock. And then bonds right now, I actually think with long-term interest rates at the high end of their 20-year range, with Treasury inflation protected securities providing a real yield, so 10-year tips providing a real yield of 2%. And then look, MBS, mortgage-backed securities, that's another area to look at, where MBS trades at a relatively wide yield premium to duration equivalent treasuries. So it's just like having a 40% allocation to the Barclays aggregate bond index. I think that's over. That's not to say that the 60-40 is dead. It's just that traditional asset allocation, the 40% to the Barclays Ag. I think that's an anachronism. But yeah, it's the 60-40 has died. People have just declared it dead for a long time. It still does fine. I still think we need bonds in our portfolio, but not just bonds. We should have some gold. We should have some trend following. We should have some, a healthy allocation to property and casualty insurers, stuff like that, consumer staple stocks. And so it's just, that's how you think that's how you're going to outperform going forward.
What's the most aggressive, again, I'm not asking you to give away secret sauce or whatever in the total portfolio, but like besides Bitcoin, what's the most aggressive thing in there?
Well, we have some AI related stocks. One of them we just added in the past few months. It's a semiconductor equipment manufacturer. So Taiwan Semi is the largest, most important. That's not the stock, but Taiwan Semi is the largest, most important semiconductor foundry in the world. And this company is Taiwan Semi's largest supplier, largest single supplier. And so this company benefits from the AI boom, but it's also, just over the long term, it's a great business. It's not, valuation's reasonable. So that's it's not as sexy as as Bitcoin or some of the high flyers, but yeah, I think that's a really great position in our get rich sleeve.
So I saw a presentation recently at the value investing conference in Vail that I go to every year. And there was a guy there who said he owns all the big semiconductor equipment companies, like, AMAT, LCRX, ASML, Tokyo Electron, KLAC, all of them, because they own basically all those five companies. They own the whole industry, and that industry, he painted a favorable picture of the outlook for that industry, which of course ties in with the enormous capital spending and AI boom that we mentioned earlier. So that you just mentioned again. So I was like, wow, he owns all of them. That's amazing. But it made a little bit of sense because they all kind of own pieces of the industry. So it doesn't
Yeah.
surprise me at all that that was the answer to my question.
Yeah. Well, they're all, most of those have great businesses. We did recommend ASML in the flagship newsletter in 2022, I believe, or 2023.
Mm-hmm.
That's been a big winner. But yeah, it's you don't have to. You could still have exposure to the AI boom and not be over your skis and not be taking on too much risk.
Right. And what I've mentioned here and there, maybe in Extreme Value or someplace, is that if you own a bunch of really good businesses, nowadays especially, they're going to be, you can't, like, everything is a tech company almost. That's not literally true, but the point is pretty clear. You own a great business, it wants to stay a great business. They're going to use artificial intelligence some way to remain competitive, to maintain their competitive advantage, become more efficient, etc. So it's almost, I mean, you can go AI specific, you can buy, semiconductor equipment or semiconductor or something else. But I'm amazed that, like, in Extreme Value, we've been able to do that. We've been able to take advantage of this trend by not even hardly trying. It's so ubiquitous. It's so necessary. A lot of people in a lot of industries, provided you don't buy one of the companies that's going to be seriously disrupted, you can't escape it, I guess, is what is my point. It's hard to get away from it. I don't know, for what
Yeah.
that's worth.
Yeah.
And that is what has been pushing the overall stock market higher to that point, right? Like, that's just every time somebody thinks AI is over, it's not, right? It's or questioning it. We just learn more and more new things every day. So it's it's definitely fascinating. To that point, where do you think, Alan, that we may be in this secular bull market in terms of? Do you have a view on? Do you care? Do you have a view on where, innings wise, we may be in the secular bull market? I mean, they're typically, right, what are they, 15, 20 years or something like that on average, or something like that, but maybe longer. Where are we in this one? If we go back to your chart, we're coming out 2010, the start of the current run we've been on.
Yeah, maybe we're in the seventh inning. I think when you look at valuations, and that long-term trend chart is it's sort of a proxy for valuation. And
Mm-hmm.
so the S&P 500 overall is very expensive relative to its history. We actually have a free cash flow yield valuation indicator that I look at, and the market is, I would say, very expensive, not a bubble, but maybe there's some disagreement there. But yeah, it's I think longer term returns, expected returns are lower, but yeah, it really matters what are we going to have in the next 2 or 3 years. You can't get too defensive or too bearish. You just have to sort of play the market that's in front of you. And that's, again, that speaks to the balanced approach that we have.
Yeah, you can't sell everything and head for the hills. It's just dumb. Like, everybody says, Dan, you're so bearish. You're so bearish. I'm like, in the past 4 years or 5 years, I think I've made, like 100 long picks or something. I mean, like the amount of long picks I made, like, it's just like sometimes I'm making them 3 at a time in one of my newsletters. You can't mistake what's going on here. But anyway,
But you're bearish.
yeah,
Then.
that's so bearish. Yes.
That I think that gets back to my point. I think when I came on the podcast a few years ago, we should always be looking for opportunities. It's no matter how bearish we are, just always be looking for opportunities. And look, and I think, well, we could probably have a debate as to where interest rates are going to go. So a lot of people think interest rates are going to head much higher. We have debt problems. There's a huge deficit. I don't know if it's all that productive to have it, to try to forecast what's going to happen there. But look, we can set up win-win scenarios. So we can look at where.
Right.
So we just recommended a real estate investment trust. And REITs it's an interest rate sensitive group because of borrowing costs and how interest rates impact property valuations. And so it's no surprise that REITs are a hated industry group. Mm-hmm. And so we just recommended a REIT that it's down 25% since its all-time highs. It's now trading at a significant discount to its 5-year valuation, or based on funds to price to funds from operations. It currently has a 5.5% yield. It's growing FFO at a 5% rate, and it has an A- credit rating from S&P. So if rates decline, if long-term rates decline, this thing's is gonna rip higher. And even if long-term interest rates do continue to rise, this stock is gonna do fine because of the yield, because of the growth. It has a solid balance sheet, high investment grade credit rating, and so no matter what happens with interest rates, I think this is going to be a solid investment.
Right. And to Alan's point, everyone, we don't spend our days like looking at charts of the S&P 500 trying to figure out where to short it. We spend our days looking at securities, doing security selection, bottom up, one company, one industry at a time, trying to find attractive situations. So, yeah,
it's hard to short the S&P at all-time highs, right? And it's probably not a great idea.
No. Yeah. And you just don't want to, just generally that whole thing. But Alan, you mentioned forecasting. Have you read a book called The Humble Investor by Dan Rasmussen? He's been on the show a couple of times. It's a fairly new book. Yeah.
No, I haven't read it. I know of Dan. I think I read his work and it's great. Yeah.
So he tells the story, and he told it on the show, of some guy in the military. Maybe it was during World War II or something. I forget when, but this meteorologist who studied the Army's like weather forecasting ability, and he said these forecasts are always wrong. And he put a report and it made it up to the general, and the message came back from the general and said, we appreciate your report on the forecasts, and we know they're wrong, but the general needs them for planning purposes. It's like, right. Like that's the value of forecasting. It's like, how bad do you want to delude yourself? So, we don't do that. We just, what you said reminded me of Howard Marks's viewpoint. It's like, where do we stand basically? How do things look right now? How attractive is the environment right now? And regardless of the environment, we're still going to look at securities one at a time, day after day after day. It's practically a secret of life to do this. I mean, practically the ultimate investing secret, Forget about all this macro stuff and just find great businesses. I mean, it sounds so simple. Why doesn't everybody do it?
Yeah.
Yeah, and that REIT sounds like the perfect example. Like, it's whatever happens with interest rates, it's gonna help it out. Yeah. And I guess the key, maybe we could talk a little bit more about we're layering on the stock selection, like just the correlation part of the portfolio, like or the lower correlated assets, and the going back to the managed futures being negative. I guess you could find it's fairly easier to find lower correlated assets to stocks than negative, correct?
Right. Yeah.
Right.
Well, even REITs where you have a relatively high correlation to the broader market. But yeah, I think it's really a matter of finding when the risk reward, is favorable. A lot of times it's after a big, period of underperformance. But yeah, we look at the sector exposures that we have. We look at the factor exposures we have. The factors would be, say, value, momentum, growth, and we just, it's hard to do the correlations on, with individual stocks, but we look at those sector and factor exposures a lot, and just make sure that we're not out of whack anywhere, that the portfolio will be resilient in a number of different environments.
Let me ask the question a different way.
Yeah.
When you're building the total portfolio for Stansberry, do you say, well, either in specific, precise or rough terms or any term, do you say, well, we want to have about so much percent of the portfolio zero or negative correlated? Do you do that?
No.
You just wind up.
No.
How do you do it then? How do you say, well, we want to have this asset because it's negative correlated, or zero, zero or negative? Do you just sort of find them one at a time and then you say, hey, here's one? I mean, how do they wind up in there then? You just want to have them, I guess.
Well, like I said before, we have the managed futures ETFs in there. That's our largest single exposure if you add them up. And yeah, the rest is just it's not always a quantitative endeavor. It's just we're looking at the best. We're looking at what's out of favor. We're looking at the best risk reward opportunities out there, and yeah, it's
that warms my heart. By
again,
the way, I just want to, if you had said we got to have X%, I would have gone, oh, okay, yeah.
No, it's not. There are no set set buckets or brackets or levels. We have about 30 to 35 positions typically, and that sounds like a lot, but when you consider, okay, we have two trend following ETFs, right? We want healthy exposure to P&C insurance, property and casualty insurance. We don't want, so we have, say, 6 to 10% typically in property casualty insurers, but we don't want that all in one, so we break that up. So that might be 2 or 3 individual positions. We have a couple consumer staple stocks. We also have a consumer staple ETF, and then we have 2. So for gold, you could have just a straight exposure to gold. We have 2 right now. We have 2 gold royalty companies, and that's how we've chosen to have our gold exposure. Basically, they give us a little more beta to the movement in gold. And also those stocks, when you look at gold stocks relative to the underlying precious metal price, the gold stocks have, they haven't really moved as much as you would expect during this massive gold bull market. So we have 2 of those, and so when you add up all these individual exposures and positions, we get to about 30 to 35.
So folks, you can't, like, AI isn't replacing our committee anytime soon here for the total portfolio. It's a group of real humans who know what they're doing. So for which there will be no substitute indefinitely, I am certain.
Yep, it's a science yeah, it's there's some science, but it's also an art. It's not just quantitative. And yeah, that's you have to adapt to the environment, and yeah, it's tough.
Well, now that I've
Yeah.
broached the topic, I'll ask both of you actually, if you have a view on the singularity, if the idea that AI is rapidly approaching, or will approach at some point, the ability to outthink humans, or think like a human and think better than a human. Alan?
I don't know if we're going to see AGI soon, but look, when the CEO of Amazon last week came out and said, look, AI is taking, we're going to cut our workforce. Eventually, people are going to be doing different things, but in the short term, AI is doing some things that a lot of people did. So we're going to reduce our workforce. And I think that it's a really big deal. It's going to be interesting to see how young kids coming out of college, how they're able to enter the workforce, because I feel like a lot of companies are going to say, well, why would we hire these entry level people, because we just have AI do it. But then you run into the problem where you have your junior level employees, and they eventually gain experience and they become senior level, and so then you don't have that pipeline. That could be a problem. But yeah, I just think AI is, everyone needs to adapt. Everyone should try to be using it in their work, in their daily augmenting their daily routines, because it may not be AI that's going to take your job, but someone using AI well, I think will take your job. And I think ultimately it could be a huge disinflationary force, where you just don't have that wage growth because we'll need less people. Companies will just hire less people. And then in the next recession, I think it's going to be interesting to see. I don't know when this will occur, but in the next recession, we're going to have layoffs. And then are those companies going to hire people back, or are they just going to say, well, we could do this with AI and automate it? I don't know. It's maybe a long. I didn't really answer your question. It's a long.
No, it's a good answer.
But
It was a good answer. So basically, it sounds like next week Stansberry is going to say Dan Ferris is fired, Alan Gula gets a raise, the whole total portfolio investment committee gets a raise, and Dan's out of here. So Corey,
no,
where do you stand on
And
all
Corey too. Yeah. And Corey too. He's done
this?
too.
Yeah, we're gone. Just gone.
I mean, I think that AI is obviously, and already is, eliminating some jobs. It's also going to create a lot of new ones that don't exist yet, as far as interacting with the AI itself, I think. And just like the internet did, I mean, like literally what we're doing right now wouldn't have existed, 20, 30 years ago very easily. So, or at all, it couldn't have existed in its the form we're doing now. So that will happen with AI. For somebody who grew up writing words and started their career writing words for a living, that is concerning, because in some ways, I think AI can do the same thing. It can't have that, like I don't think it can ever, and I hope it can't ever, create like original thought, right? Like I mean, that maybe that's the next thing coming with the generative AI, but for now at least, I feel like it won't completely replace humans, and if it does, what are we doing at all, like on Earth? Like what will we end up doing? Hopefully we won't let it get to that point, because it's possibility is probably there at some point, but that's where my head's at right now.
Yeah, I think it's easy. It's really easy to envision this dystopian future where AI AI takes a lot of jobs. Then you'll have an AI tax, and then the funds like a UBI, Universal Basic Income, or something like that, where
Yeah.
And like companies that use that use AI for 50% of their output, they're gonna tax companies this way. and there's going to be much more unemployment. I think it's really easy. I could see the optimistic viewpoints, but yeah, it's really easy to have a sort of pessimistic take on this.
Yeah, it is. It's probably too easy to go either way with it. But my thought is that I just don't feel like you can, there's you can't replace human beings. Maybe that's too, I'm too conceited. It's too much hubris about the value of human life or something like that. You could say. So I can understand that viewpoint, but humans have been really well. When I think of myself from day to day, like maybe you could say that 99% of my thoughts are useless, but I can't see how like there's a machine that could do this. You know what I'm saying? A machine is not this crazy. A machine does not entertain this much insanity. Now, a machine would probably come up with all kinds of things that I might not come up with and try to act on them. You can say these scenarios where the machine takes over and says, "Oh, the answer to this is to declare nuclear war on so and so, or to wipe out the human race, or something like that." But other than that kind of thing, there's something about human beings like that I just can't probably articulate very well. I think about the way we live. Like, would a robot have a dog? I mean, would a robot really appreciate having a dog? Can robots love? Can machines love and ever really feel emotions? They could be made to imitate them to some degree, I suppose, but would they ever feel them? I just I have a hard time with this idea that they're going to overtake humans in some important way and somehow make us redundant. They're going to get people fired, I guess. There's a redundancy there, isn't there? But overall, throughout history, technology has tended to make people more productive, even if all the weavers get fired and the loom makes the workers who are left more highly productive. I have to keep believing that that's the way it's going to go, even if it's these transitions aren't easy, but I have to believe that's the way it's going to go. Anyway, just for whatever that's worth to anybody, I couldn't help asking. But we've made it to time for our final question, and it's the same question for every guest. As a previous guest, you've answered it before, Alan, and no matter what the topic, non-financial, any topic, identical question. If you've already said the answer, feel free to repeat it. There's no harm in that. And the question is simple. If you could leave our listeners with one thought, one takeaway today, this is like your big chance. Tell them what the takeaway is that you want them to have today.
Well, I think I touched on it throughout. I think investors should go through their portfolios and make sure they're diversified. If you don't have any international stocks, if you don't have some gold, you don't have some bonds, if you're young, don't have at least a little bit of crypto exposure, if you don't have AI exposure, if you don't have managed futures in there, you're not fully taking advantage of diversification. So I think diversification is going to be really important in the next going forward. And that's my advice.
Amen, brother. I couldn't agree more. This is the time for that message, more so than any time in my career, in my life, probably. Thanks, Alan. It's always a pleasure to talk with you, and I hope we can do it again soon.
Yep, great to be here. Thanks, guys.
Thanks.
Opinions expressed on this program are solely those of the contributor and do not necessarily